While everyone was celebrating the soft landing headlines last month, when analysts claimed inflation was cooling and supply chains were returning to normal, something far more serious was happening behind closed doors. A single institutional withdrawal request hit CME records, and almost nobody noticed it, but one detail should freeze you. The settlement date is January 12th, 2026, and this isn't a routine redemption. It's one of the largest physical silver delivery demands ever filed in a first quarter window, large enough to wipe out an entire month of U.S. supply in one stroke. Let me show you why this isn't just another industrial purchase. It's a calculated move that exposes a structural weakness the U.S. financial system has been hiding since 2011. Because the timing isn't random and the buyer isn't panicking, they're executing. Think about what happened in Shanghai 2 weeks ago. China increased its strategic silver imports for the fourth month in a row, yet stopped reporting refinery inflows. At the same time, 3 Asian smelters quietly halted new commercial contracts until February, the exact period that overlaps with the January 12th U.S. withdrawal. Meanwhile, Wall Street analysts reassured everyone that silver's surge to $63 per ounce was temporary. They claimed supply was stable. They claimed industrial demand would cool. Here's what they missed. China isn't reducing pressure. They're tightening it, right as the U.S. faces its most dangerous physical delivery test in 20 years. This isn't about price volatility. It's about control. Because when a market built on leverage runs into a real-world shortage, the price doesn't move gradually. It detonates. January 12th isn't a date. It's a trigger. And when it fires, the first people to feel it won't be traders. It'll be every institution holding paper silver that can't be backed by metal that no longer exists. Let me show you why this single withdrawal could be the catalyst that shoves silver past $70, and why the window to react is closing much faster than anyone understands. To understand why January 12th is so dangerous, you need to see what's been quietly happening beneath the surface of the silver market for the past 14 years. Because the shortage didn't begin this winter. It began the moment banks realized they could sell silver that didn't actually exist. Here's the part nobody realized. Since 2010, the world has consumed 1.5 billion more ounces of silver than it produced. That shouldn't be possible in a normal market, but on COMEX, it works, because banks can satisfy demand with paper contracts instead of metal. That illusion holds until someone asks for delivery. The January 12th withdrawal is exactly that moment, a stress test. A showdown between physical silver and the paper promises created to suppress its price. Think about what happened in March 2020. A single delivery. Wave drained more than 50% of New York vault inventories in just 10 days. Silver shot upward instantly. Refiners went on allocation. Industrial buyers panicked. Now amplify that event. Because this withdrawal isn't just bigger. It's concentrated at the worst possible time. U.S. mine output is down. Mexican exports have tightened. And Asian refiners are limiting shipments until February. That means the system is entering January with one of the lowest global buffers in modern history. But here's the mathematical trap. For every ounce of real silver in the COMEX system, there are nearly 300 ounces worth of paper claims. That ratio isn't speculation. It comes directly from CME data. It's a structure built on confidence. Confidence that nobody will demand metal. January 12th shatters that assumption, because if one delivery reveals a shortfall, the next delivery doesn't wait. It accelerates. It triggers a chain reaction where every holder rushes to convert paper to metal before the vaults run dry. This already happened before. In 1968, London gold dealers faced the same imbalance. When physical demand overwhelmed paper contracts, the London gold pool broke in 48 hours. Gold doubled. The dollar cracked. The entire global monetary system rewired itself. Silver is now sitting in that exact same position, but with far tighter supply and far greater industrial dependence. And this is where the real danger begins. Silver isn't just a monetary metal. It's a critical industrial input for solar panels, EVs, defense systems, semiconductor fabrication, water purification, and high-efficiency batteries. A supply shock isn't just a financial event. It's a manufacturing shutdown. If a shortage hits in mid-January, industrial buyers will do what they always do. They'll outbid investors and drain the remaining supply at any price. The banks will try to defend the paper structure. The refiners will claim temporary delays. Analysts will downplay the emergency. But the math doesn't care. A deficit is a deficit. A withdrawal is a withdrawal. A shortage is a shortage. And once the market sees that physical metal is disappearing faster than it can be replaced, price targets become irrelevant. Silver doesn't move in percentages, it gaps. That's why $70 isn't a prediction. It's the next logical step in a process that's already in motion. The withdrawal is coming, the inventories are thinning, the system is cracking, and January 12th is the moment the entire world will see it. Here's where the story turns from a supply squeeze into a structural failure. Because January 12th isn't just about one withdrawal, it's about what that withdrawal exposes inside the system itself. A system that has been stretched, leveraged, and hollowed out for more than a decade. Think about what COMEX actually is. It's not a warehouse. It's an insurance mechanism, a place where banks promise metal they assume they'll never have to deliver. But when delivery gets forced, the insurance model breaks. And when the insurance model breaks, the price disconnect begins. We've already seen the early signs. In November, industrial buyers quietly offered spot plus 25% premiums just to secure future supply. Solar manufacturers in Korea began prepaying for 2026 shipments. 2 U.S. electronics companies attempted to buy directly from mines, bypassing refiners entirely. That only happens when fear is spreading behind the scenes. And now, something even more dangerous has appeared. The divergence between COMEX price and physical price is widening again. This already happened before. In 2021, when retail investors hit the market, physical premiums soared while COMEX lagged behind by nearly 20%. The exchange survived only because industrial demand collapsed temporarily during pandemic shutdowns. But this time, industrial demand is at record highs. That means when price diverges, the system can't reset downward. It snaps upward. Here's the part nobody talks about. For the past 3 months, refiners in Switzerland, India, and Singapore have all reported the same phenomenon. Orders are increasing, but shipments are decreasing. Not because they don't want to deliver, but because they can't secure enough feedstock to refine. When the world's largest metal processors are rationing inputs, the shortage is not coming, it's here. And January 12th is the first date where this shortage goes public. Now, combine that with the banking side of the story. Large U.S. institutions are sitting on enormous short positions they rolled over when silver was in the $22, $24 range. Those positions were never designed for a market trading above $60, and they were definitely not designed for a market facing a physical drain. If delivery requests spike after January 12th, banks face 3 impossible choices. They can deliver physical metal they don't have, they can buy silver at rising prices to cover shorts, accelerating the breakout, or they can declare force majeure, instantly destroying confidence in the market. Every option leads to the same outcome, higher prices. Because once confidence cracks, paper evaporates. And once paper evaporates, the entire structure collapses down to physical supply, which is already in deficit. This is the moment when silver stops behaving like a commodity and starts behaving like a currency under stress. It stops trading on forecasts. It starts trading on survival. Industrial buyers hoard, investors panic buy, mints sell out, refiners allocate, vaults drain, shorts burn, and the price curve goes vertical, not gradually, instantly. That's what January 12 threatens to activate. Not a shortage, a revelation, not a rally, a repricing, not speculation, mathematics. Because when the system can no longer hide the deficit becomes the system, and $70 becomes the first stop, not the final destination. Here's the question almost nobody's asking. What happens after silver breaks $70? Not the price target, the mechanism. Because $70 isn't just a number on a chart. It's the line where the global system reveals who survives and who doesn't. Think about the industries that rely on silver every single day. Solar manufacturing, electric vehicles, defense systems, medical equipment, electronics, energy storage, telecommunications. None of these industries can function without silver. There is no substitute. There is no replacement. There is no workaround. So when the price reprices, their entire cost structure reprices with it. And when that happens, 3 dominoes begin to fall. First, defaults. Companies that built their projections on $20 silver cannot survive $70 silver. Their margins collapse. Their contracts collapse. Their financing collapses. Second, rationing. Governments intervene, forcing metal towards strategic sectors, leaving everyone else stranded. Third, priority pricing. Buyers start outbidding each other simply to stay alive, turning the market into a survival auction. This is what happened during the 1979 silver crisis. This is what happened during the 2021 semiconductor shortage. This is what happened during every historical resource shock. But in 2026, there's one critical difference. The United States no longer dominates silver production. China no longer exports it. Mexico is already running near its extraction limit. Recycling cannot bridge the deficit. So the next phase is not merely a shortage. It is a global struggle for allocation, a world where the nation with the most metal controls the pace of industrial expansion, and the nation with the least watches its supply chains break. And this brings us to the part that affects you directly. When this transition hits, it will not be analysts or institutions who move first. It will be ordinary people who suddenly wake up to a simple realization. Every dollar they hold is losing purchasing power. Every ounce of metal they hold is gaining it. Your bank balance remains a number. Silver becomes a claim on reality. The The moment industrial buyers start competing with retail holders, the price ladder stops working, markets don't rise smoothly, they gap. $70 becomes $82 overnight, $82 becomes $94 in a single session. And one morning, you wake up and realize the price has moved so far, so fast, that participation is no longer a financial decision. It's a defensive one. That's why January 12th matters, not because of the withdrawal itself, but because of what the withdrawal exposes: a decade of hidden deficits, a market built on paper promises, a commodity that functions like infrastructure, a monetary metal trapped in a currency crisis. When the system meets that kind of truth, it doesn't bend, it breaks. And when it breaks, the world won't be arguing about whether silver should be $30, $50, or $70. They'll be asking a much harder question: how high does a price go when the world realizes it never had enough to begin with? That's the moment we're moving toward. Not slowly, not theoretically, but inevitably. And now that you've seen the mechanism behind it, you understand what most people won't notice until it's too late.